Hi everyone, in this video I'm going to answer the question, which stock is the better buy, Build.com or Roku? And to answer that question, I'm going to look at 6 different metrics starting with revenue growth. So let's get right into it. And what you see here is a significant jump in revenue growth for Build.com, over 150%, and it's been coming downward, but still 66% revenue growth in its most recent quarter. However, this could be misleading because Build.com has made several acquisitions, and that could be boosting its revenue inorganically, whereas Roku is growing its revenue more organically without acquisitions, delivering solid revenue growth that has been coming down recently, but still over double digits. Of course, Roku was a prime beneficiary during the pandemic, and now that tailwind is reversing and turning into a headwind going forward. So difficult to judge here. It's very close because Build.com is achieving better revenue growth, but Roku's revenue growth is more organic. So I'm going to call this a tie here in terms of revenue growth. The next metric I wanted to look at is operating margin for the trailing 12 months. And in this regard, you see Roku on the top in the purple with the clear advantage, although still negative 8.31% in operating margin. Build.com just going in the wrong direction, negative 42.79%. Of course, it's difficult to digest these acquisitions. It takes time, takes some cost, and over time, you can expect this to improve, although it hasn't yet proven that just yet. While Roku was delivering very nice expansion in terms of operating margin until about late 2021, when inflation really started to bite into its cost structure, and the management chose not to raise prices and rather to absorb these higher costs in order to protect consumers and to attract more customers. And that's why Roku's operating margin and gross profit margin has been coming down in recent quarters. So the advantage here, Roku over Build.com in terms of operating margin. The next metric I wanted to look at is cash flow from operations in the trailing 12 months. And a bit of opposite stories here. Roku was doing an excellent job expanding its cash flow from operations in the trailing 12 months, a peak of over 240 million, and that's just turned downward, unfortunately, negative 21 million in the trailing 12 months. And again, that's connected to the fact that management chose to absorb the higher costs and the fact that revenue growth has slowed down, and that's brought down its cash flow from operations. Meanwhile, Build.com has been expanding its cash flow from operations, huge boost in the trailing 12 months in 2022 to positive 89.35 million. So advantage in cash flow from operations to Build.com. The next metric I wanted to look at is total assets. Because of the way Build.com has went about achieving its growth through acquisition, I wanted to see what its total asset was, because I would much prefer a company that's earning a similar amount of cash flow on lower amount of assets, an asset light business model, rather than a company that needs more assets to deliver the same amount of cash flow, and all else being equal, because I want a higher return on assets, right? And so Build.com here, looking at its total assets quarterly, you could see a big jump here. They were very close to Roku in terms of total assets, and they significantly jumped here up to $9.7 billion in total assets, while Roku at just $4.39 billion in total assets. So in this regard, I would say Roku has the advantage. The next metric I wanted to look at is total long-term debt, because I wanted to see if their total assets are increasing. One of the ways you increase your total assets is by borrowing to purchase companies, right? And that is the case to some degree for Build.com, as its debt has soared from relatively flat to 1.77 billion while Roku has only 89 million in debt. So a significant advantage to Roku here, because all else being equal, you want a company with less debt, right? Debt is risky. You have to make interest payments on debt, and if you don't come up with the principal payments on debt, then that could be extremely risky. So you have to really manage debt carefully, and Bill.com, with its soaring debt over the last 2 years, is a lot more risky than Roku, and so advantage Roku. Finally, to answer the question, I wanted to look at valuation. I chose to use price to free cash flow and price to sales ratio. And looking at price to free cash flow, Roku at 66 is less expensive than Bill.com at 153, although this information could be a little bit misleading, because Roku's free cash flow has turned negative as of July of 2022, so we don't have the updated metrics in this regard. So I'm taking less of a information value from this metric, more so from the price to sales ratio. And looking at this metric, Bill.com at 12.06 price to sales, Roku at 2.73 price to sales, significantly less expensive than Bill.com. And so to answer the question, which one of these two is the better stocks to buy, I'm going to say Roku is the better stock to buy. Bill.com's strategy of acquisition and the increasing long-term debt comes with very much more risk, and also having to pay a much higher valuation for Bill.com increases that risk further. So given those factors, I'm going to say Roku is the better stock to buy here. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.